What is happening, investors? It is your boy Jack. I had a shave and I am not a financial advisor. Today I want to speak to you about my 10 favourite Dividend Aristocrats, all of which I own, so you know that I actually do believe in these companies. I'm not just speaking about them for the sake of the video. If you don't know what a Dividend Aristocrat is, it's a company who's been paying out a dividend for over 25 consecutive years to their investors. So this means that even when times get tough, even during the Great Recession, these companies still rewarded their investors with dividends. So if you're somebody who absolutely loves dividends and is always looking to buy some new dividend stocks, but you're not quite sure where to look right now because of how uncertain times are economically, this could help you out a little bit. I have stocks ranging from a 2.7% yearly dividend yield all the way up to very close to 9%. So a wide variety of stocks, some that would be deemed as very safe, you know, even growth stocks, and some that are a little bit higher risk. So there's something in there for everyone. So in these videos where we speak about 10 plus stocks, I'm obviously not going to do a full analysis on every video, or else it would literally be hours and hours long. So I'm just going to give a brief explanation of each company, you know, maybe have a look at how they've performed the last 5-10 years, you know, have a look at some balance sheets, whatever is most interesting. But I don't want the video to be like 4 hours long, so we're only going to try spend, you know, a maximum of 2 to 3 minutes on each company. Right before we get into it though, guys, I'm so happy we hit 4,000 subs yesterday. You guys are absolutely crazy. The support I'm getting in the comment section as of late, it brightens my day every single day. It genuinely makes me so happy. So to everybody smashing the like button, everybody dropping me the comments, and everybody who has subscribed so far, I genuinely appreciate you so much. When we get to 5,000 subs, I'm going to reveal to you my entire portfolio. We're going to do a full breakdown, and then you'll actually know exactly what I'm invested in and how much I'm invested in these companies. And I'm also going to do my absolute best to have the online store ready for 5k subs. Now, that all depends on how long it takes, because you guys are crazy and it could happen a lot quicker than I expect it to, and I want to make sure everything's perfect before I sell anything to anyone. I don't want to sell bad products, so I'm going to have to get samples sent out, everything along those lines, but I'm going to do my best. So with that being said, please smash the video a like right now, drop me a comment, let me know what your favourite stocks are, what stocks you're looking to buy next week. I'm always really interested in, and drop me a sub if you're not a part of the family just yet. Again, let's get the 5,000, baby. Now, with all of that being said, let's get straight into the video. We're going to start with the company that has the lowest dividend yield and work our way up. We have McDonald's with a 77 dividend safety, a 2.71% dividend yield, and an actual 45 plus year dividend streak. So they're very close to turning into a dividend king. A dividend king is a company who's paid a dividend for over 50 years. So right now they are an aristocrat, but they're approaching that king status. Now, I'm not going to show you my positions in the companies because I want to save that for the 5k special, but I will tell you that I am up 10.75% in my investment in McDonald's, so they've obviously done quite well for me. Now, I really don't think I have to explain to people why McDonald's could potentially be a good stock to buy. This is one of those ones that I think you would have in the large majority of portfolios. It's a relatively safe growth stock. They do pay a dividend, and they have done for 45 plus years. And everybody knows who they are. They made $21.08 billion in 2019. They were founded back in 1940, and they have developed themselves into the biggest fast food chain in the entire world. No matter where you go in the world, you're going to find a McDonald's. It does not matter where you are. Aside from obviously, you know, certain third world countries and things along those lines, but you get the picture. So the Mac stock chart, fantastic growth all around. Back in 1999 to 2002 maybe wasn't the best, but ever since then, it has been up and up and up. And then we're going to have a look. We'll have a look at the 5-year first of all, and you can just see some nice steady growth in general. 120-ish% in 5 years. That's nothing to sneeze at. We're going to go over to the 6-month chart, and we can see that from the highs down to the lows, these guys dropped about 36%, which I actually thought was a very considerable drop for a company like McDonald's. And we can see right now, they're still sitting down negative 15%. So these guys obviously were hit relatively hard by the virus. You know, a lot of their stores had to shut down. In Ireland, where I'm from right now, every single McDonald's, to the best of my knowledge, is still shut down, and I'm sure this happened in a lot of other countries as well. I don't see a world without McDonald's. I think as soon as things get back to normal, as soon as all of their stores are open again, they're going to be absolutely fine. They're just going to go back to doing what they do best, selling their chicken nuggets, selling their cheeseburgers. And McDonald's do have a very decent balance sheet, especially when we look at their current situation. Okay, so current assets, 7.5 billion. Total assets, 50.5 billion. Current liabilities, almost 4 billion. So that would say to me that the dividend looks quite safe. And their total liabilities are nearly 60 billion. So not the best in the whole world. You know, you don't look at it and drop your jaw in amazement, but still quite a good balance sheet. So we'll leave it there for McDonald's. Now, company number 2. Now again, remember we're starting with the smallest dividends first. So the most exciting companies will be around at the end of the video. So stick around for that. But second up, we have Johnson & Johnson, another company that in the world of investing at least needs no introduction whatsoever. Okay, so a dividend safety of 99, a dividend yield of 2.8%, and they are a dividend king with an uninterrupted dividend streak of 57 plus years. And these are one of the companies who throughout this whole situation actually managed to increase their dividend. They increased that dividend by 6%, just reaffirming how safe this dividend is. And again, it's a company, we have a look at the max stock chart, and historically there has just been absolutely immense growth. Again, let's have a look at the last 5 years, okay, and we can see they were about $100, and another company, they've gone up about 54% or so from lows to highs. So this definitely isn't a growth stock, you know, it's not one of your spec stocks, it's not a Facebook, but it is a very safe stock that a lot of people like to have in their portfolios. And they've had quite a nice recovery from highs to lows. They dropped down about 27%, not much whatsoever, and right now they're only down about 6.25%, and they had even made very small new highs at one stage. Easy to understand why they haven't done particularly poorly is because they sell products predominantly that people need, okay? Zyrtec, Tylenol, Mordant, Benadryl, Listerine, Band-Aid, Johnson's, Aveeno, Neutrogena. Things people need. You have a headache, if you're in the US, you're going to get Tylenol. If you're in Ireland like me, which I think like 2% of you are, you're going to get paracetamol. They sell products that people need, it really is that simple. They have this incredible max stock chart. There is nothing but slow, consistent growth, and they pay that dividend. It's just perceived by an awful lot of people as one of the safest companies to own. And quite a nice balance sheet. Current assets, over 44 billion. Total assets, 155 billion. Current liabilities, 33.5-ish billion. And total liabilities, 93.7 billion. So quite a nice balance sheet. Just remember for me, guys, the stocks that I'm showing today, I'm going through very quickly. If you do want to invest in these guys, I highly recommend you go and do much more research into them yourself. Some of the companies I'll have done full reviews on the channel. And remember, again, I'm not a financial advisor. I'm not telling you to go buy these companies. I just want to put them onto your radar. So with that being said, company number 3. A company with very similar statistics to Johnson & Johnson. Procter & Gamble. Again, very similar in what they do. They provide products that people need no matter what. Okay, so a dividend safety of 99. A dividend yield of 2.81% and an uninterrupted dividend streak of 62 plus years. So again, a dividend king. These guys sell things like your Tide Pods, your Ariel Pods, Pampers, lady products, male products, kitchen roll, toilet roll. Again, products that people need despite what's happening in the economy. And again, it's a company where we look at the max stock chart and it is just slow and steady growth to the upside. Okay, so we'll have a look at the 5-year chart first of all, and we can see that they were up about 60-ish%, so doing quite well. We go back down to the 6-month chart and we see from highs to lows, it was a bit of a shaky road. They only dropped 22-ish%, and as of right now, they're only down 11%. So again, just reaffirming, you know, how not volatile these guys are when times get tough. Now we're looking at one of my favorite companies in the whole world. I have a full video comparing these guys to Coca-Cola if you'd like to check that out. Now, Coca-Cola could have made today's list as well, but I said I'd leave them off and just throw in Pepsi. But yeah, Coke obviously are a fantastic company as well. But Pepsi, dividend safety of 93, dividend yield of 3.13%, and again, a fantastic uninterrupted dividend streak of 47 plus years. They're very close to that dividend king status. They have 22 iconic brands with more than $1 billion in annual sales. And what I mentioned in my Pepsi versus Coke stock video is that one of the reasons I prefer Pepsi is because they also sell snacks. So they have Lay's, they have Doritos, they have Quaker Oats, and then they also have their drinks. They have Pepsi, they have Gatorade. They're in Starbucks, they have their own water, Mountain Dew, obviously Pepsi. That's why I just think they just about take the edge. And again, it's just a beautiful max stock chart. I mean, it's just up and up and up. We look at the last 5 years, and again, it's up and up and up about 50%. So, you know, it's one of these standard companies. You know, you expect maybe 10% or so a year on average, and then you get the extra bit of dividend on top. We go down to the 6-month chart, and we see that the drop these guys face was close to 30%, and they're still down about 11.23%. And another company with a decent balance sheet, okay, current assets just over 24 billion, total assets 85 billion, current liabilities 22 billion, and total liabilities 71.5 billion. So decent balance sheet all in all. They have that 47 plus year history of paying that dividend. It is at quite a nice 3-ish%. Their max stock chart paints a pretty picture. It's a good bet, you know. Again, it's a company like McDonald's. I don't see a world without Pepsi. Now, our 5th company of the day is Cat, and the next 5 are all above a 5% dividend. So things will start to get a little bit more exciting after these guys. But Cat, okay? 93 dividend safety, 3.66% dividend yield, and a 27 plus year dividend growth streak. Their solid liquidity expects to support dividend. This was all the way back in April 29th. Nothing has changed since then. We definitely expect this dividend to be able to continue to be paid despite everything that's happened. So what should be said about Cat from the start is that they're relatively cyclical in nature. The first 4 companies we spoke about today, you know, they're all relatively safe. It doesn't really matter what the economy does. They're not going to be hit too badly. Whereas a company like Cat most certainly can be. They operate through 4 business segments, okay? Energy and transportation, which is 38% of their profit. That serves oil and gas, power generation, industrial and transportation markets. We all know what is happening in the world of oil right now, so obviously they would have taken a big hit because of this. And on top of that, construction industries is 38% of their profit, and that's tied to infrastructure spending. So that is all intertwined, and that's the large majority of their profit. So when oil is doing bad, Caterpillar are going to do bad. And then again, resource industry, 16% driven by mining and heavy construction, and then financial products provides financing for Caterpillar equipment. So these 3 here, the big 3 that take up 90+% of their profit, will have all been hit quite toughly as of late. And so you can see when we look at the max stock chart, it's very different than the first 4 companies. It's not just slow, steady growth upwards. There's big growth spikes, then big dips, then big spikes, then big dips, then big spikes, then big dips. So this is definitely the kind of company you want to be buying when things are going poorly, in hopes that you catch the next big spike, okay? So let's just have a quick look at the 5-year chart, you know? They were down at $85-ish. They went up in the span of a couple of years, nearly 100%. Since then, things started going back downhill a little bit, you know? They somewhat traded sideways. It wasn't absolutely horrific, and now we've seen this dip. Then we look at the 6-month chart, okay? And from the highs down to the lows, we're down nearly 40%. And they're still down about 25%. So I know oil is still in a bit of a weird place. A lot of people aren't comfortable, you know, investing into any company that has anything to do with oil. But that's not me. It's actually one of the industries I'm buying most aggressively into at the moment, and I love the look of Cat. So although as of right now they are one of my worst performing companies, I'm absolutely fine with that, and I understand that the recovery may take a little bit longer, but when the recovery does happen, I think that the growth is going to happen a lot faster than some of the safer companies. And I do like having a very diversified portfolio. A lot of companies that I think, you know, will just pay me slowly but surely over the years, will pay me my nice 2, 3, even 4% dividend. And then I like to have some companies in there who I think when things turn around are going to pay me the matter of hundreds of percent in a matter of years. But with Cat, when things are going good, they go very good, as we see by that nearly 170% upwards movement in 2 years. That's why I'm more than happy to buy into them now when they're still quite low compared to where they have been, because I believe in the long term something good would happen. But anyway, I'll leave Cat there. Now, on to some of the bigger dividend payers, the 5+% guys. First up, we're having a look at Realty Income Corp, okay? Dividend safety of 70, dividend yield of 5.36%, and an uninterrupted dividend streak of 25+ years. So they just barely make the cut in regards to being an aristocrat. So these guys are an REIT right now, and REITs have been hit relatively hard because a lot of people aren't paying their rent, okay? Realty Income's April rent collection beats peers, but is still problematic. So they bet a lot of other rates, but it's still not in the best place in the world, and we can see that they released earnings and reported that 83% of rent was collected in April. So that means there's 17% of their rent that they did not get paid. So again, this is a company who can be a little bit more cyclical in nature, and obviously when times get tough can be hit harder than certain other industries. But to me, that's just given more of an opportunity to get in at a relatively cheap price. Because again, when we look at the max stock chart, it has for the most part just been steady growth upwards. The 5-year chart, and this is what I mean by the fact that it is cyclical. You know what, look at that, 50+% in a matter of a year, and then they dropped back down, they were only up 7%, and then they went on this big upwards movement up over 80%, and then from that peak to where we are right now, they're still down 36-ish%. We dropped as low as 50% pretty much, so they're still well down there. But when economies start opening back up, when the world starts opening back up, these guys are going to reap in the benefits. So these are some of Realty's big tenants. We have Walgreens, 7-Eleven, FedEx, Walmart, Sainsbury's. A lot of guys I don't know because I'm not from America, but they're massive tenants, some of which aren't going to be able to open right now, won't be wanting to pay their rent for a while. And you know what? When things are good again, they will pay that rent. So again, this is one of those companies that I'm only really happy to buy when I think it's relatively undervalued, and that's exactly where I think it's at right now. Okay, so on to number 7. Okay, we're looking at Chevron Corp. And it's one, I don't know what it is, but they just get me excited for some reason. Okay, so there's a dividend safety of 65. A dividend yield of 5.72%. They said back when all this started happening, they're focusing on protecting the dividend, and they have that uninterrupted dividend streak of 33 plus years. So it's easy to understand why they want to keep the dividend payments up. Now here's another company that was hit quite hard, hit very hard, down 55% from highs to lows, and as of right now still sitting down about 25%. And again, these guys are in oil and gas, so I won't repeat myself, I won't say everything that I said about CAT, but you get the picture why they will have been hit so hard. So a quick look at the balance sheet: 28.5 billion in current assets, 236.67 billion in total assets, massive total assets, 28.2 billion in current liabilities, and 91.7 billion in total liabilities. So again, I see a company that has a decent balance sheet. I mean, yeah, you know, current assets to current liabilities, it's all right, it's not the best in the world, but from that 5.72% dividend yield point of view, I think this is very safe. I don't even think that 65 is fair. I really don't see them stopping paying this dividend anytime soon. Unless this oil crisis gets prolonged for years and years, I don't see this happening. But it's just another company where when things are good, and when things are bad, they're very bad. Look what happened. There was a very bad thing that happened, and this could, you know, go on for another few months very, very easily. But I think when things are good again, we're going to see another massive spike like this, and there will be some very good opportunity to take out some very big profits. Okay, we've 3 companies left, and we have 3 big boys, 3 massive dividends. First up, we're looking at AT&T. Now, I am going to make a full video on these guys someday soon, probably in the next week or two, okay? But right now, we'll keep it really quick. AT&T dividend safety of 65, dividend yield of essentially 7%, and uninterrupted dividend streak of 36 plus years. They do expect to maintain healthy dividend coverage. So a massive reason why you invest in these guys is for that dividend yield, is for that 7% dividend yield. And you'll see that when we look at the stock. I mean, when we look at the max stock chart, it don't look that pretty. Let's all be completely honest. And that's why I won't let these guys become an absolutely massive position on my portfolio. But I mean, come on. That 7% dividend yield that has the potential to go higher and higher, that in my opinion is relatively safe, it's very attractive. And when you're a long-term investor, if I buy AT&T, I plan on holding on to them for 20, 30 plus years, all going well, the dividend's going to pay for itself. So although I do like being diversified, and I don't want to put all of my money into the really high paying dividend companies because oftentimes they don't come with the most growth, I do still want a decent part of my portfolio to be focused on these dividends. But I 100% completely understand if you have no interest in this company. I do get it. If that's not your investing style, that's not your investing style. But I think it's fine having these take up some percentage of my portfolio. But I mean, let's just look at the last 5 years, you know? They can go up 25% like it's nothing. They can go down 20-ish% like it's nothing. They can come back to break even. And then we look at the last 6 months, okay? From highs to lows, 30% dip, okay? Still down 22.6%. This is one of the reasons that I am quite happy to buy them right now, because I see a company that has tended to move sideways in a particular price point for the last 5 years, okay? It's been up and down, but it's been in this range. If I can buy them at the bottom, and I do think that gradually over time they're going to continue to move upwards, which, if we have a look at the max stock chart, can be said to be relatively true. Very slowly and steady, it does tend to make higher highs and higher lows. So if I can get them at a good price, if I believe that they're going to keep paying me these dividends regardless, I think it's a relatively good deal. But I'm not going to get into them because I will make a full video on them. So now we really are onto the big boys. If you can guess who the last company is going to be, drop your guess in the comments right now. If you're up to date with the channel, you do know who they are. I'll give you that as a hint. But anyway, second last company, Exxon Mobil Corp. One of my absolute favorites. I know there's a lot of mixed opinions on these guys, but one of my personal favorites. Dividend safety of only 55. Dividend yield of 7.8%, okay? Dividend streak of 37 plus years. I think they've handled this whole situation that's been thrown at them absolutely expertly, okay? So, obviously we won't go into depth, but they've reduced spending and reaffirmed their commitment to the dividend. A lot of people get very, very worried when we look at the max stock chart, and I completely understand why. And again, this is a company that I do plan on making a full video on one day in the next couple of weeks, so I won't go into big detail. The last 6 months, these guys got hammered down to a low of negative 55%, okay? Right now, they're still down 37.1%, so it's extremely poor. And what makes matters worse is that over the last 5 years, things have been quite poor as well. You know, it has been a downtrend. It hasn't been good whatsoever. And when we look at the max stock chart, things just are messy. You know, they're pretty much all over the place. But really, the last 5 years is what causes a lot of concern. I'll get into why it doesn't concern me in the future video, but do your own research, you'll figure out why. Massive company with 50.25 billion in current assets, okay? 355 billion in total assets, 64.7 billion in current liabilities, and 167 billion in total liabilities. So, good balance sheet. I know obviously the current assets and the current liabilities don't look the best, but their total assets are absolutely fantastic. I do 100% believe that, especially given the fact they've managed to cut their spending, this dividend is safe. I don't think it'll get cut. I don't think it'll get cancelled. They understand how important it is to their investors. They're going to keep it. And again, as I mentioned earlier, oil is one of the industries I'm actually investing in quite heavily at the moment, just because of the fact that they've been hit particularly hard. And they're one of the industries that in nature is cyclical. So when something like this happens and they get hit really hard, I see a good buying opportunity. But that is just me. It does not mean that you have to agree with me or that you should buy any oil related stocks. And as always, I'm not a financial advisor, baby. I got the hoodie to prove it, and I got the mug, and I got the t-shirt, and you're going to have them soon. So we're about to go on to the very last company. Have your guess in your head. Have your guess in your head. I'm interested to know if you guys know who it's going to be. It is the one and only Altria Group, with a dividend yield of almost 9%. Again, a dividend safety of 55, and an uninterrupted dividend streak of over 50 years, guys. I don't know why I didn't buy these guys earlier, I'll be completely honest with you, but I am very happy to own them now. And look, right now, these guys can be seen as a little bit scary to some people. The future is uncertain in regards to what they're trying to do. If you don't know who they are, their main product is and always has been cigarettes. And the number of people smoking in the US and worldwide has been going down and down for literally decades. But these guys understand that, and they're taking action, okay? They're in Kronos, okay? An emerging global cannabinoid company. They're in ABInBev, a global beer industry leader. They're in wine, they always have been. They're getting into Juul, into vapes, nicotine patches. They're expanding absolutely massively, and I genuinely think that this could be one of my best investments. I know that's a big statement, but I do think that these guys have so much upside potential. People might be smoking less, but that doesn't mean that people are drinking less, or they're vaping less, or they're using nicotine patches less. Now, I know a lot of people obviously are, but there's still a lot of people using those services. And this one in particular, cannabis. I think cannabis is going to have an absolutely massive market in the decades to come. Just the fact that it's only really starting to become legal. And Kronos are one of the big players. We're in Kronos through investing in Altria. It's exciting stuff. And look, again, it's been a bad few years, and I'm happy to point that out, and it doesn't deter me. Up until that point, the growth had been absolutely immense. If your only argument for not buying these guys is the fact that less and less people are smoking, well then why has all this growth happened, you know? Why from 2000 did they go up over 1500% in a matter of, what's that, 17 years? Because this whole time there's been less and less people smoking. So because these guys have fallen on a tough few years, you know, from the very peaks down to where we're at now, they're still down 50%, and that's across the span of a few years, you know. If we have a look at the 6-month chart, they're currently down about 24%. So definitely not what I would say is one of the safest investments you could ever make, but you know what? I think the reward does outweigh the risk here. And again, as long as they're part of a diversified portfolio, I'm very happy to own them. And I will probably put a decent bit of cash into these guys, to be honest with you. They may seem somewhat spec to a lot of people because we don't know the exact future that they're going to have, but I love them. So guys, that is it. They are my top 10 dividend aristocrats, some of which are actually dividend kings that I own and I am interested in owning more of going forwards into the future. Please do remember that this video was just intended to, you know, put some stocks onto your radar so that you can go and do some more research on them. I'm not telling you to go out and buy any of these stocks, but I do always like to, you know, give you guys some ideas. So there was obviously some very safe, small yield companies in there at the start of the video, and then some of the higher risk companies at the end. Most of the companies at the end I will at some stage make a full video on, just because generally the companies with the higher dividends are a little bit higher risk and they're not as straightforward as just buying them and expecting that they'll go up a certain amount every year. So if you'd like any particular stock covered, let me know down in the comments. And also if you'd like a video similar to this one, but just for dividend kings, the companies who've paid dividends for over 50 years, let me know in the comments as well, because I'd be more than happy to make a video like that, especially if this one does well. But again guys, just thank you all so much for 4,000 subs. It's all happened so quickly. It's absolutely amazing. Only like 3 months ago, I think I was at 700, 800 subs, something like that. It's crazy. I appreciate you all so much for smashing that like button, for dropping me in the comments, for subbing to the channel. It genuinely means an awful lot to me. And with that guys, I'm going to end the video here. So I hope you all have an absolutely fantastic day. I will catch you for tomorrow's video. Have a good one. Peace.